What's up, everybody? Welcome to the Stocks Channel. My name is Cory, and today I'm bringing you a special update, and I'm bringing you the Stocks Channel members only video for absolutely free. All that I ask is that you smash that like button and help this video reach 2,000 likes. If you like what you see from this members update, you can get more videos like this by joining the Stocks Channel Discord, and you can find out how to do that by clicking on the link below. So please remember to smash that like button, and without further ado, let's crack open these charts and see what's going on in the stock market today. Welcome to the members video. For the December's member video, we're going to look at the bear and bull scenarios that will take SPY well out into the rest of the year and also cover early next year. And I'll be giving you the exact price levels you need to pay attention to understand whether the bear scenario or the bull scenario is the one playing out. Remember, we always trade on price action, triggers, and technical analysis, but we will also look at the fundamental picture because I do think it's important to understand the fundamental landscape, because this is a very rare market that comes around once in a lifetime where the Fed is stuck between a rock and a hard place, and it's very important to understand why that is. So if you want to skip the fundamental part, there will be chapters that you could skip right past it, but I do want to start with the fundamental picture first. So as you could tell from the text on the screen, we're saying the fundamentals equal bearish, with number one reason being the Fed's job is not done. The Fed's job is not done because the labor market is still too strong, which is not in line with their 2% inflation goal, and the Fed will need a recession to defeat inflation and ensure the inflation does not return. If we go into a recession, that means we're getting lower PE ratios for the S&P 500, as corporate earnings will continue to be lower and have lower guidance. The stock market will continue to go lower as a result. So for that reason, the fundamentals tell us the bear market is likely not yet over, so it is important to keep that in the back of your mind. Of course, there is the slight possibility that we avoid a recession and that we do not see the lower PE ratios, but right now it does look like the Fed is trying to drive the economy into a recession. So that is going to be our base case for the fundamentals. Okay, so now to go over the fundamental reasons why we likely think the bear market is not over is going to be the inflation and labor market speech Fed Chair Jerome Powell just gave on November 30th, 2022. So we already saw what he said at FOMC, and he seemed to echo the exact same thing yet again. So this is very important to understand that there is likely no Fed pivot coming in sight, and I'm going to go over exactly what he's saying and tell you why it means there is no Fed pivot coming around the corner. So the first thing Jerome Powell said is the report must begin by acknowledging the reality that inflation remains far too high. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. He goes on to say it will take substantially more evidence to give comfort that inflation is actually declining by any standard. Inflation remains much too high. Scrolling down and continuing to go through the bullet points of why Fed Chair is still hawkish, we see that he is saying that we anticipate that ongoing increases will be appropriate. I will simply say that we have more ground to cover. We can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace for a sustained period. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. Continuing to move on to the important topics of what he's talking about, he then goes on to say in the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. Continuing on, we can see that he also goes on to say, for the near term, a moderation of labor market demand growth will be required to restore balance to the labor market. But for wage growth to be sustainable, it needs to be consistent with 2% inflation. Despite some promising developments, we have a long way to go in restoring price stability. Ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. So he goes on to finalize his entire speech by saying it is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So it is my opinion, and it is very clear from reading this, that Fed Chair Jerome Powell is still hawkish, and he is using the 1970s stagflation, where the inflation just kept coming back every time the Fed tried to back off, as his base case to stay hawkish until the job is done. So that is why we are going to continue to say the fundamentals remain bearish, because we are likely going to see the Fed driving us into recession. Now, Jerome Powell likes to use this term soft landing, and he's even gone on to call it a softish landing because he does not want the market to just crash down to the lower levels. He is trying to allow for the market to react to the restrictive policy, and he's trying to walk the market down slowly. And that is exactly why we continue to get these bear market relief rallies followed by the next leg lower. So based on everything he said and where we are currently at in this state of the current market, this still does look like a bear market relief rally that is more in line with his soft landing approach, because he doesn't just want the market to go straight down to SPX 3000 in a straight line. He wants the market to have time to bounce and work its way down there slowly. So the fundamental picture does match the technical picture, and we are currently at very critical resistance that we need to acknowledge, because this is exactly the time where the Fed is likely going to step in and try to drive us down for that next leg lower to continue that soft landing approach. Whether or not the Fed is successful with the soft landing or we just crash down and get a hard landing is to be determined, but we are going to know through the technicals which scenario is playing out, and that is why we will now go over the bear scenario and the bull scenario together. And I'm going to give you the exact price action you need to pay attention to understand which scenario is playing out. We know fundamentally it's likely going to be the bear scenario, but you can never only understand one scenario, because in the event we get the bull scenario, you're going to be caught off guard and you won't understand what's happening with the market. So if there's one thing I want you to take away today, it's that you need to put in the work and understand both the bull scenario and the bear scenario, and understand the price action that you need to watch to understand which one is playing out, and then make your trade plan so that you are prepared for either scenario. And from there, I want you to let the price action do all of the talking and check any biases at the door. Okay, so first we'll do the bear scenario, and the bear scenario is very simple because we are currently at the bear market resistance trend line, which is going to be this level at SPY 408. And we also have the 50% retracement of the bear market, which is going to be SPY 414. So in the bearish scenario, we are either going to see SPY reject from 408 or 414 and then continue for the next leg lower in this bear market, which should easily go down here to fill this gap at 380 and then continue to retest the previous lows down here right around 350 and possibly even start down towards the lower price targets. As you can tell, if we draw this arrow, that would take us out to at least the end of January of 2023, which takes us well into the beginning of next year, and we will likely see either a retest of the lows at 350, start down towards 338, and then below that we're likely heading down towards about 320 to 318. This bearish scenario is very simple because you're just managing risk between SPY 408 and 414, and personally I would use the level at 414 because if we break above 414, you instantly know that this market is a lot stronger than we expected, and it is less and less likely that we're getting the bearish scenario if we continue to see a strong bull trend. So in the bear scenario, you could use this risk level at 414, and then your confirmation is going to be the break of this support trend line, and that is a moving target, so we will have to watch that each and every day with our daily analysis. The other risk level you can wait for confirmation that we're going lower will be the breakdown below this support zone at 393, which if you remember from last month's member only video, that was the level that we were using to get bullish or bearish above or below that level. And as you can tell, ever since we did break above 393, we have gone more in a bullish direction, being up about 4% from that level since we had the breakout. So if you bought the breakout at 393 and used that as your risk level, you easily made at least 4% in SPY thus far, and possibly even more if you continue to trade from that level each and every time we tested it. So 393 is a great risk level for the bulls, because if we start breaking below 393, you instantly need to expect that the bears are getting stronger and starting to drive SPY lower, and we're more than likely going to start down towards the bearish path, which is going to be down towards at least SPY 350 to retest the lows. So if you're going with the bearish scenario, you are managing risk around 408 and 414 with your confirmation in the price action on a break below the support trend line and then a break below 393. It is really that simple, so go write up your trade plan with those levels and know exactly how you're going to trade when we see those price action occurrences. Next up, we'll do the bullish scenario, and in the bullish scenario, we are likely going to see this bull trend in the short term continue on as we get the break of 408, and then we will see that test of SPY 414. And if we are going to see the bullish scenario playing out, we will see SPY break above 414 and we will get confirmation of a break above the resistance trend line and the 50% retracement of this bear market. From there, we should easily see SPY running up to fill this gap around 421 and very likely testing the previous daily high at 430 and possibly even going up to about 436 to 437. From there, the bulls will be exhausted and will likely get a pullback all the way back down towards 414 to about 400 or possibly a little bit lower, because the bulls will need to take a break and we will need to correct that bull run. After that bull run corrects, we should see one more leg higher that should take us all the way up to about SPY 445 to 450, and that does take us all the way out into March of next year. So obviously we will have to update this analysis as time goes on. So in the short term, you're more focused on SPY reaching about 420 to 430 to finish out the year and take us well into early next year. That is only if SPY breaks out above 408 and then gets the breakout above 414, and you want to use your risk level as the 200 daily moving average, which is now currently right around SPY 404, and then of course the level of the support trend line, which is a moving target, and that level down here at 393. As a bull, you can use any of those support levels to manage your risk, because if we start breaking down below those levels, you will need to exit your position because we're more than likely getting the bear scenario that we just went over. So know both of these scenarios, and I just gave you all of the price action occurrences that is going to tell you which scenario is favored, and that should be the direction that you're trading in. Right now, this is a very tricky market because you have the longer term downtrend that says you should be shorting the market at resistance, and then you have the shorter term uptrend that says you should be going long at the market at support. So when you get a market that has great trading, you more than likely should be taking both directions of the trade. Short at resistance and buy at support, and then once one of them starts failing, you'll know to favor the other side of the trade more, and you can completely stop taking the long trades if we lose support, or completely stop taking the short trades if we break through resistance. Again, how you write up your trade plan is up to you. I'm just trying to give you some ideas. But right now, this is a very bipolar market while we are above a short-term rising trend and a long-term declining trend. And then eventually we will see a breakout in one of these directions. And it's going to be a lot more clear which side of the trade is winning. So just know both of those scenarios and plan accordingly. And then one more thing that just shows we are not necessarily in a very strong bull market is that the tech sector is not leading the way. If we go to the NASDAQ 100, we're not even at the negatively sloping 200 daily moving average. And I am a firm believer that if you are in a strong bull market, you are going to see the tech sector leading the way higher. And we're just not seeing that, which does favor the bearish scenario. If we start to see tech taking over and we start to get the bullish breakout, tech has a lot more gains to make up, so I do suggest getting a lot more tech heavy if we do get the bull market scenario, because the tech sector is very beaten up. There is a lot more fruit on that tree that you can harvest. If you do get the bull breakout with the bull scenario, I do suggest taking advantage of the tech stocks that are the most beat up, because they have the most to gain because they also lost the most. So if we don't see the NDX taking leadership, it's more and more in line that we're going to follow that bearish scenario. And then one last chart I want to show that favors the bear scenario is if you just take a chart of the SP 500 SPX index and you graph it over a chart of the VIX, you can clearly see that every time the VIX gets down in this range at these low troughs, that is synonymous with the SPX peaks that we've had in this bear market. Now, this doesn't guarantee that this is a peak, because if we get the price action breakout in the bullish scenario, we instantly need to assume the VIX is going to continue to trend lower. But as you can tell from a risk reward standpoint and your odds of winning a trade, it is very clear the bears have the best risk reward setup right now, with the extremely low VIX, which is exactly where the SP 500 has been topping out, and the fact that the bears are right at resistance, so they are right at the risk levels that define their risk for short trades. So they have much better risk reward ratios, which automatically means if they are trading in the direction of the bear market downtrend with great risk reward ratios, there is going to be a lot more money taking those trades, which is likely going to drive the market lower. You will need some major bullish catalysts to override all of that strength the bears currently have. And that is why if we do get the bull breakout, you need to respect it, and you will need to follow the price action and trend, because if you remain bearish during a bullish breakout, you will lose a lot of money, because the bull breakout is going to tell you you need to jump ship on the bearish trades and start getting a lot more bullish. So right now, yes, everything looks bearish, but that could change in an instant. And that is why I say if we get the break of resistance and we see these charts that are bearish starting to deteriorate, you instantly need to get bullish. So yes, the biases in the fundamental picture are bearish, but we always let the price action and the trend do all of the talking. So we will instantly get more bullish if these charts start to deteriorate and we start to get those bull breakouts. If you haven't already, please remember to like this video, and if you're new to the channel, also remember to subscribe for more daily analysis. If you want more members videos just like this and you want my intraday analysis and updates, also consider joining the Stocks Channel Discord, which you can find out how to join by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.